Life insurance can be very confusing for most folks, and there's a lot to learn when it comes to the right life insurance policy to get. So, if you have any questions on life insurance, this is the video for you. Derek Mazzarella with Gateway Financial Partners, and I'm here to talk about really the basics of life insurance. What is it? Why you should have it, how much should you get, and what are the different types and when you use those different types of insurance. Let's jump right in. So, what is it? Really, it's just a contract between you and the insurance carrier that states if I pass away and I have the life insurance contract, my beneficiaries will get a lump sum death benefit. And the lump sum death benefit comes tax free in almost most cases with life insurance. Okay, why should you actually get life insurance? There's a concept called insurable interest. Basically, you need a reason to buy life insurance, either on yourself or another person. So you can't just go out and buy life insurance on Harry Styles, hoping that he's going to pass away someday. You've got to actually have a good reason to buy it. So, what are some of the reasons that people actually purchase life insurance? First one is most common. It's probably family. Most people think their most important asset is their house. It's actually your ability to earn an income. So if you all of a sudden weren't able to earn an income for your family, how would that impact your family? Most people would be pretty devastated in general, even more so when you add the financial impact on it. So life insurance helps cover at least the financial impact of an early death. Two is business. Okay, let's say you're a business owner and you have maybe a partnership. There's things called a buy-sell agreement. And that's where quickly, let's say you have another partner or a couple partners, and if one of you passed away, what would typically happen is now that person's spouse or beneficiaries, they're the new partner. In most cases, they don't want to be the partner. So life insurance provides liquidity to buy that party out. So now you become the sole business owner of the business. So life insurance is used in buy-sell agreements to protect your business interest. Secondly, some companies, they have key employees. These are people that are very viable to very important to the viability of the business. So let's say you have a key salesperson, they bring in a majority of the sales. If something were to happen to that person, that could be devastating for the business. So buying life insurance, once again, provides that liquidity of excess cash to help you either find someone else or give you some time to kind of ramp up sales back again because it gives you that flow of cash when you need it most. The third thing is estate planning. Most people look at the federal limits and say they're very high right now. I'm never going to be in that category. But there's a couple of reasons you may actually want to buy life insurance for your estate in general. So one is some estate taxes have actually pretty low limits. Massachusetts, for example, has $1 million threshold. It means if you have assets over $1 million, you're going to trigger their estate tax. So that's a pretty low limit when you consider housing values in Massachusetts. Second, it can provide some liquidity for family members to either buy each other out of certain assets because some families may have a lot of their wealth tied up in things like real estate, for example. Life insurance provides liquidity to help manage that process and the probate process and all that stuff that you may need some liquidity for, whether it's buying kids buying each other out or just providing some other liquidity during the estate tax process. Third is most people don't think about this, but it's insurability. And insurability looks at your health. Life insurance isn't like buying a pack of gum at the grocery store. You have to go through a process in order to get it. And the insurance carriers are going to underwrite your health. So they're going to make sure, are you healthy enough to buy this? And if you're not healthy enough, and you have a bad medical history, you're not going to be able to buy life insurance. Now, most people when they're young are able to actually buy insurance. So buying insurance earlier on typically locks in that health, your good health early on. I don't know too many people other than maybe Benjamin Button that get healthier as they get older. Okay. Here's the real age-old question. This is the thing that most people struggle with, and I can tend to struggle with exactly how much to get for life insurance. One of the biggest things I hear most often is, "Oh, I don't want to over-insure myself." And one thing I want to make sure is very clear is you cannot get too much insurance. The insurance carrier will cap you out. So if you're a person that makes $30,000 a year, you can't go out and buy a $20 million policy. The insurance carriers will not let you do it. Okay? There's a limit they look at. And the way I want you to think of it, it's basically a concept called their human life value. So I want you to think of a car accident. Okay, let's say you're in a car accident and you get hit. You can't work for the rest of your life. Most people in that scenario are going to sue someone for that, the person that hit them, if they're at fault. And what they'll get from the court is basically their salary times the number of years till they're age 65. So if you're a 35-year-old, they're going to multiply your salary by 30 years because you have 30 years to 65. So that's your human life value. And that's typically the most that the insurance carriers are going to give you. So let's say, using that example, you're 35, you make $100,000 a year. So 30 times 100K, it's going to be, you're eligible for $3 million of death benefit. Okay. So that's exactly how that works. Now, you may look at that and say, whoa, there's no way I'll ever need, or my family will ever need $3 million. And that could be the case. But what are some of the things you want to evaluate? So one is, what's your debt? So do you have a mortgage debt? Do you have credit card debt? Do you have a boat that has some debt? Think about all the debts you have, because your debts should be covered. We should be trying to cover your debts with the death benefit. Two is, what are your family needs? Are they solely able to live on your spouse's income? If not, they need to supplement it somehow. Third, you're going to look at college. A lot of clients I work with that have kids, their goal is to help their children pay for college. If that is a goal of yours, you want to add the cost of college to the death benefit. And then four, are there any kind of wants that you have that you want to make sure people are covered? You want to maybe give them a buffer. One of the most powerful things I've seen about life insurance and the death benefit is it gives you the ability of not rushing decisions. So oftentimes people give you advice, oh, you got to sell their house, you got to do this, you got to do that. But think about how that actually works in practice. Let's say you're a family, you have young kids, you pass away or your spouse passes away. Now everyone's telling your kids who just lost their parent, hey, now you got to move into a different house. So life insurance is one of those things that can help with that process, because it gives you the time flexibility to do that. So those are some of the things you want to look at. Look at kind of what do you want to have happen, how do you want to treat it, what do you want to really kind of financially see happen with this scenario. So those are some of the main things you look at. It may end up being your human life value. It may be a little less than that, but this is going to be a personal decision that you're going to have to try and look at and figure out on your own. Okay. So what are the different types? And they break down in two main categories. The first one is term insurance, and then there's permanent insurance. There's pros and cons to both of them. So with term insurance, you're essentially buying insurance for a number of years. So you're saying, okay, I'm 30 right now. I want 20 years of coverage, so I'm going to cover this till I'm 50. And then once you hit 50, that insurance goes away, and you can either buy it at 50, or you can choose not to buy it. So term insurance is typically good for those types of expenses that you're looking at that go away. So things like debt, because over time, you're going to be paying off your mortgage. And over time, hopefully you're saving towards college. So maybe you have a majority of college funded through a 529 plan or something else. If you have questions on that, check out my college planning video. Or your debt's getting paid off over time. So the need for the insurance typically drops over time. And the things that go away are the things that you want to cover with term insurance. Because the big benefit of term insurance is it's the lowest cost option. Right, so it's going to be the cheapest thing. The downside is you do run out. So at a certain point, you're going to no longer have coverage. And the question is, back to the insurability, maybe you're 20 years older now, you may not be as healthy, so you may not be able to get it 20 years later. So that is a big risk of term insurance. So the benefits, it's cheaper, it's going to cover the things that go away at some point, and you can get a lot more of your death benefit for your dollar. So when it comes to permanent insurance, it's going to be, more expensive. But the minute you buy it, the insurance carrier, as long as you continue to make premiums on time and on schedule, they're guaranteeing that you're going to pay a benefit out to you when you die. And we know we're all going to die at some point. So whether that's you dying at 60 or whether it's you dying at 100. Okay, so permanent insurance is basically, guaranteeing that you're going to get paid a death benefit at some point. Okay, it is more expensive. It does cover you, essentially for life. And then some of them will actually build up cash value. So think of it as kind of investment vehicle. And then the tax treatment of permanent insurance is another benefit. So the biggest tax benefit of life insurance is it works pretty much like a Roth. You use after-tax dollars. The cash value will grow tax-free, and you could take it out as a loan as a tax-free withdrawal. Okay. If you decide not to take it out as a loan, they're going to look at what you put in versus what you're taking out. And if there's any difference, you're going to pay taxes on the difference. And you're going to pay income tax rates on that difference. So if you put in 50,000 and now it grew to 75,000, you take all 75,000 out, you're paying taxes on that $25,000 at your income tax rates. So I want to make sure that's clear. So there's definitely some pros and cons, and there's definitely some fits between, hey, this is when I buy term insurance and this is when I buy perm insurance. So perm insurance you're typically buying for, hey, maybe you need life insurance in retirement, or maybe you need it for estate planning. That's usually when permanent insurance is a good vehicle for you. Also, it can be used as a supplementary tax, savings vehicle for you. So when it comes to permanent insurance, there are actually a few different types. So there's whole life insurance, there's variable life insurance, universal life insurance, and indexed universal life insurance. Just like term versus permanent, each of these options have their pros and cons and their fits within a financial plan. So let's start with whole life insurance. Whole life insurance is the least sexy of all these. It basically just gives you typically a rate of return over time. It's most consistent and it's going to be the most predictable benefit. So basically, it's going to build up cash value. And it's going to build up cash value based on a few things. It's going to look at, the interest that the insurance carrier earns on your premiums. So I'm going to put that in here, interest. Their ability to make a profit. Because with most whole life policies, there's a mutual company and there's, publicly traded companies. Mutual companies will typically give money back to their policyholders because you're basically a part owner of it. So, their interest payment and their profitability are big reasons for their dividend payments. So basically their cash value builds based on their ability to pay dividends. So it's the most consistent. So basically, if you want to think of whole life, you're paying a flat premium throughout your life, and then your cash value is going to slowly build up over time. Okay, so it's typically going to earn 3 to 5% per year, depending on interest rate environment. Okay, so the benefit is it's the most safe of the permanent options, the most predictable, and it's typically going to have a rate of return similar to bonds. Not exactly like bonds, but it's going to be somewhat similar to bonds. Next is universal life. So universal life is very interest rate dependent. So instead of returning money back to the shareholders through dividends, they typically look at an interest rate return, and they're very dependent on interest rates. So I started the business a while back, and I was looking at old policies from the 80s, and when interest rates were 12, 13, 14%, these policies did really well, and they returned a good amount of return based on the high interest rate environment. But what happened is over time, interest rates dropped, and that hurt the viability of the policy. So there is some interest rate risk when it comes to universal life policies. So if you're ever getting an illustration, you want to make sure you're being very conservative based on the interest rate environment, because that can really impact the cash value buildup over time. So this does also build up cash value, but it's based on, interest rates. So the benefit of these tend to be cheaper compared to whole life policies, but there's definitely a little bit more risk involved with universal life policies versus whole life policies. In between that, there's called an indexed universal life policy. So if you want a little bit more upside, they're basically going to say, okay, we're going to track an index. And an index is typically a market index like the S&P 500, which is the 500 largest U.S. companies. And what they do is they put a cap and a floor on it. So let's say the S&P 500 goes up, it goes down, it goes up, right? Because typically um, markets are volatile and they'll move consistently. So say, okay, we're going to cap you at, let's say, a 5% ceiling and a 0% floor. All that means is that, let's say the market dropped, 10%, your life insurance policy cash value will grow by 0%. If the market goes up, let's say 15%, you're still capped at 5%. So your cash value will grow by 5% that year. And if it's anything in between, you're going to get that. So let's say it's 2.5%, your cash value will go by 2.5%. So it does give you some market exposure. Typically, there's more upside compared to a whole life or universal life, but it does cap a lot of the downside with that floor. Okay. So, they're going to be more cost effective than whole life, but they can have a little bit more varying degrees of success based on, the stock market environment and the index that you're investing the cash value to. The last one at the full end of the spectrum, this is going to be the riskiest. And this is a variable life policy. And variable life policies just really tie your rate of return to the market. So these are going to be more flexible in terms of investment options. Typically, they're investing in mutual funds. And they're going to give you the rate of return of whatever the mutual fund you're investing in. So you can invest in stocks and bonds, and they allow for a lot more investment flexibility than the other options. So these are typically good fits when you're the person that doesn't necessarily need the death benefit for this policy. This is all about, that the tax benefit of the life insurance chassis. So usually they're kind of a rich person's Roth. They're the point where I'm maxing out my 401k, I've got an investment account, and now I want to be a little more tax efficient with my investments because they do tend to be more expensive than investment accounts. So what you're really paying for, is this tax treatment of the life insurance policy. So variable life policies will help give you the ability to earn a higher rate of return. So you're going to probably potentially have a better cash value as you get closer to retirement. But there's more risk. So if you're investing in stocks, you know that you can lose money in a year. So there's definitely more risk involved with that. So if you're on that point where you're typically a little younger, you've got some time on your side, but you just want to have a better tax efficient vehicle, a variable life insurance policy could be a good fit for you. So, generally when we look at all these different types, whole life's going to be good if you're a little bit more of a consistent, concerned investor that wants to make sure they have consistent returns on their whole life policy, or you're using it from an estate tax planning vehicle. Universal life is also a very good estate tax planning vehicle because they tend to be cheaper. You can get a guaranteed one that'll pay to age, or guaranteed to a certain age. They're usually good for estate planning as well. And some of those you can actually buy a second to die policy, so they'll kick in when say you have two spouses. When the second spouse passes away, that's when they'll trigger the beneficiary of the benefit. And index and variable life will give you some market-based returns overall. So when we look at life insurance overall, we're looking at a few different factors. Why you should get it is based on, do you have a family need? Do you have a business need for it? Do you have an insurability risk? And do you have any estate planning issues? Those are usually 4 core reasons to get life insurance. There's several different types. There's term insurance, which you're buying it for a certain block of time. It's lower cost, but it gives you a higher death benefit. And it's typically for those things that go away, like debt, college, income replacement, things like that. But then we have permanent insurance, which will pay you basically pay you and be there as long as you're alive, and then pay a death benefit when you do pass away, which we all know will happen to all of us. And within the permanent realm, there are 4 options. There's whole life, universal life, index universal life, and variable. And each of them have different fits, and you have to kind of figure out which one makes the most sense for you. So I know I went over a lot about life insurance. I'll probably give more of a deeper dive on some of these at a later video. But if you like the video, please subscribe it, to share it with your buddies. Derek Mazzarella with Gateway Financial Partners.